Let me introduce my guest for today. We've got Suresh Sadagopan, who is the founder of Ladder 7 Financial Advisories. Thank you so much, Suresh, for taking the time. I know that this subject is close to your heart, which is why I thought of you first. Let's start with the product, though, and then we'll move into strategies. Bharat Bond ETF, this is the third tranche that is now available. But for those that are not familiar with the concept, even though it's been discussed widely, how does it work? What is it all about?
So, to give a bit of context, so currently a lot of people are talking about very low returns, and it's a fact that bank fixed deposits are giving, say, maybe 5.7 to 6.2, depending on what tenure, which bank you're talking about. And corporate deposits are not really giving much more than that, probably another 0.5, 0.7, especially the ones which have comparatively high credit quality. And if you're looking at PSU bonds, it is probably sub 5% at this point in time. And if you're looking at a whole lot of debt funds at this point in time, many of them are giving close to 5% or thereabouts. So we are really talking about a very poor return. At least at the moment, we are talking about very poor returns. In the context of that, I mean, people are really looking for high quality papers. I mean, people are, of course, concerned about the risk. COVID has brought to the fore the risk that can be there in equity market, debt market. Fortunately, we have not seen too much of meltdown in the equity market. On the contrary, it has gone up all the way. But as far as debt markets are concerned, it has performed comparatively modestly. So if we come back to the question of Bharat Bond Fund, this is the tranche 3. See, this is a fund which is going to have purely AAA-rated PSU papers. So essentially, it is a government of India undertaking, and it is all AAA-rated papers. And this particular, this particular Bharat Bond is going to have papers of residual duration of close to something like 10 years. And it is giving something like 6.5% or thereabouts is what you can expect. Roughly 6.5 to 6.6% is what you can expect. For an investor who is really looking at the long term, this is actually a great way of actually locking in on this kind of return. I'm saying locking in on this return because this is a fund which will mature at a particular point. Let us say April 15, 2032. This particular thing is going to mature at that time. So the point at issue is, if somebody has a long-term view as far as debt is concerned, and they want to lock in the return, and they don't want to take too much risk, and they are not really looking for regular return. So I'm going to talk about this in a minute. So if they are not really looking for regular return because they already are earning an income, this is an excellent way of investing. Now, somebody may say, what if somebody wants a regular return? So even if somebody wants a regular return, in the case of a typical bond, you get a regular return by way of the coupon payments. In the case of a Bharat Bond fund, whatever payments are there, it will fall into the Bharat Bond. I mean, it will form the part of the portfolio and it gets reinvested. So if at all you want to set up some level of income withdrawal, so you could do that through systematic withdrawal plan, which is anyway available in through mutual funds. Now there are two flavors of Bharat Bond fund which is available. One is a exchange traded fund format, and one is a fund of fund format. I would prefer a fund of fund format for most people, because in the case of fund of fund, the counterparty is the mutual fund. So you are assured of liquidity. So at any given point, if you want to sell that, the liquidity is assured. In the case of exchange traded fund format, there has to be a counterparty who has to buy you off so that you can sell that at whatever price. And please understand that in the case of an ETF, you will need to have a demat account, and it is bought through a broker. So it's a different platform that you will be using. In the case of mutual fund, it is through the normal mutual fund AMC route. So there is a difference between the two. So I think that is all that is to know about this. It's a fairly straightforward, simple product with a long duration, very high quality, and people who are really looking at investing for the long term, this is a wonderful product to be in.
Okay. We did get a question, and I will speak about strategy when we speak about portfolio construction. And I have a few questions about how you can withdraw from the Bharat Bond ETF. But The question that one of our viewers had when we posted on social media that we would be discussing the Bharat Bond would be, what is Bond ETF ladder strategy? How does that work? And you've already answered this. Does a Bond ETF pay regular dividend to shareholders? You've said no, and you have to construct something of a withdrawal strategy that will allow you to take regular income. So the first question, which is, what is Bond ETF ladder strategy? How does that work?
So as far as any kind of a mutual fund, any kind of a debt product is concerned, you can withdraw the amount that you are comfortable with. So let me just give an example. Let us say you have invested, let us say 10 lakh rupees. And if that particular fund is giving, let us say 6% return. So that means 60,000 is what you could potentially generate from that particular fund. So which means that 5,000 rupees is roughly what you can withdraw, or 6% is what you can actually withdraw. That is if you are going cut to cut. So normally what is suggested by most financial advisors is if you want to set up an income in perpetuity, what we will suggest is a withdrawal level which is lower than what the fund is earning. So in this case it is 6%. So for example, I may suggest something like 5% withdrawal. So that it can actually, it will not erode the corpus. At the same time, we will have a regular income which is possible to be set up. So that is what we normally use here. So if at this point in time, 4,000 rupees per month is what you require, roughly, which is about 5% withdrawal rate. So, and at a future point in time, you want to withdraw a higher amount, it gives you the possibility of withdrawing a higher amount from the debt mutual fund, because you are not withdrawing the entire interest which is accruing in that thing. So that's going to be feasible. So otherwise, laddering, the only other thing which I can think of is, I mean, if you had invested in that 2030, then 2031, and then in 2032, and if you have different products like that, then you can have one thing coming from the first one, another thing coming from the second one, third thing. But it is really not required in the case of a debt mutual fund, because a systematic withdrawal plan allows you to construct the way that you want, whether it is in the form of a monthly, quarterly, half yearly, or annual mode. You can actually construct that the way you want. So that is the biggest advantage of a systematic withdrawal in the context of a debt mutual fund.
But I think the context of this question, Suresh, is that in something that is, in this case, a long duration bond that is being held by the ETF, it would be subject to interest rate risk, right? So if you have a situation where you have rising interest rates and you have systematic withdrawal plans that are structured to allow you to get regular income, if those interest rates go up, your capital is going to shrink because it's going to be marked to market. So you're going to be withdrawing at a loss. Wouldn't that be the case?
Absolutely right. So that is precisely why normally we have we normally keep a margin of safety. So if something is giving 6%, we normally withdraw something like 5%. So we will have to. It cannot be like we have set up a systematic withdrawal at this point in time, and we don't look at it at all ever. So there are 2 points. One is, what is the requirement from the client point of view in terms of income withdrawal? Income requirements. And the second thing is, realistically, what is the market giving at that particular point? So your point is very valid. In the case of a debt mutual fund, suppose the interest rate goes up, automatically the returns of the NAVs will come down. So the effective returns in the fund will be lower. I do understand. So as advisors, we will have to look at that, and we will have to slightly bring that down so that it is sustainable in the future. The other thing also can happen potentially, where the interest rate comes down. At this point in time, I don't expect the interest rate to come down any further. At this point in time, it doesn't look likely. But suppose at some point in time it comes down, again, you may also have a situation where your fund may be giving close to 10% or even a double-digit return. So in that situation, if you want to actually take advantage of the capital appreciation to some extent, you can also set up a higher withdrawal rate. So in a sense, you will be cashing out on the capital appreciation along with whatever coupon payments are anyway inherent in the NAV. So either thing can happen. So only thing which I would say which we need to do as advisors is we need to look at every point. As clients also, we need to look at every point at least once in 6 months to a year, we need to look at whether any change needs to be done in our withdrawal strategy. So does that answer the question, Alex?
Yes, that does answer the question actually. I was also going to ask you about the tax aspect of it, because it fits in very well to this conversation that we're having about Bharat Bond. Let's talk about the tax aspect, and then after that we'll start talking about strategy, Suresh. In that, you would obviously have the same debt mutual fund strategy, right? Where you have indexation benefits after 3 years, and that's how capital gains tax works for debt mutual funds. Could you explain that a little bit for those that are not familiar?
Yeah, so a lot of people do invest directly in corporate bonds. So they invest in fixed deposit, corporate deposits, and things like that. So most of the viewers will be familiar that whatever interest or whatever coupons you are going to get, that is going to be treated as income, and whatever the income slab happens to be, so you will be paying tax as per that. And let us say the income tax slab happens to be 30%. So if you are getting 10,000 rupees, 3,000 rupees effectively will go as tax. So 7,000 rupees is the retained earnings. Whereas in the case of debt mutual fund, especially if you have held it for something like 36 months, which is 3 years, then you can actually take advantage of indexation, and then you pay 20% tax on that. So effectively what that translates to is that it translates to, let us say, to simplify it a lot, it translates to a single digit return. That is what we have seen in most cases. And mostly we have seen it translates to anywhere between 4 to 7% effective tax. Of course, it all depends on the intervening inflation in the intervening period. So we don't know what it will be. But more often than not, it will be in single digits. So a person who is paying, let us say, 30% will find this extremely, extremely attractive, because instead of paying 30%, they will be paying something like maybe 5% or 6%. So again, going back to the example of, say, that same 10,000 rupees, suppose I'm withdrawing that 10,000 rupees through systematic withdrawal, that is by cancellation of units. What I'll be paying instead of 3,000 rupees, I'll be paying on, again, like I said, a 5% or a 7%, maybe 500, 600 kind of a tax I'll be paying effectively. So there is a calculation involved. I'm not going into that. I mean, it will take more time for me to explain. But the tax will be much, much lower as compared to a typical direct investment where it is treated as an income.
Absolutely. And that sets the context, I think, Suresh, very nicely for a conversation about portfolio construction, because this is where things will get interesting. How do you plan from the bottom to the top, and in terms of the duration that you would need across that fixed income portfolio, so that you're getting the best of what is on offer. So we'll speak about that. We're going to take a short break. Suresh, do stay with us. On the other side, we'll speak about how to construct a fixed income portfolio. Do stay tuned. All right, welcome back. You're watching The Money Show, and we're speaking about fixed income. We had a great conversation about the Bharat Bond ETF, and we also spoke about taxation broadly, of how debt mutual funds are taxed. And remember, when you're talking about fixed deposits, which is compared to, and not necessarily in the right sense, effectively you're paying the slab rate. So if you're in the top tax bracket of 30%, you're basically paying 30% of tax on your interest income. So that sets the context for how to construct a fixed income portfolio. Suresh Sadagopan is speaking to us. So Suresh, one of the conundrums I think people face is that they usually match an investment with a goal, and they're encouraged to use fixed income to match shorter term goals. And so therefore, a lot of their debt investments are gravitate naturally to the shorter side of the spectrum, and they don't make investments in long-term debt instruments or fixed income products. Is that the right approach? How should one approach the construction of a fixed income portfolio?
Okay. So as far as asset allocation is concerned, so there are two parts to it. I'm going to answer the first part, which is asset allocation. So as far as a person's requirements are concerned, we have to look at how many years to retirement. We have to look at the liquidity needs, tenure needs, the risk profile of the person. We have to look at the taxation incidence. We have to look at a whole lot of things before actually we come to a broad assessment of what should be the asset allocation pattern. When we talk about asset allocation pattern, what we are talking about is how much should be in equity, how much should be in debt, how much should be in gold, real estate, and any other asset class. So going by that logic, we will have to first and foremost assess what is the strategic asset allocation that we want to have. And by that strategic asset allocation, how much do we want to keep in debt? So, so it is not a question of short term, long term, that kind of a thing. So what is the strategic asset allocation that we want to keep? So now coming to the second thing. The second thing is, see, suppose I have a goal which is say 1.5 years, 2 years, or 6 months down the line. Obviously, I cannot keep that money in equity. It has to be in something which can preserve the capital, which has to be something like a fixed income kind of a instrument or a debt instrument. So that being the case, I may want to keep that for that short term for meeting that goal in a debt or an arbitrage kind of a fund. So that which I am going to move into a debt or which I'm going to keep it in a debt or an arbitrage fund could have been, prior to that, it could have been in an equity fund, for example. Okay, so suppose I have a goal, I'm just illustrating that. Suppose I have a goal 7 years down the line, I want to buy a home. So I'm not going to keep everything in debt funds at this point in time. I'm going to have certain portion in debt and I'm going to have a certain portion in equity because this is going to come at after 7 years. However, equity, suppose I'm going to keep some portion for meeting that home goal. I cannot keep it in equity till the time I'm going to buy the house. So probably 2 years before that event, I may have to move it into a debt instrument, some kind of a debt instrument. So what will happen is at that point in time, the debt allocation will bloat in my portfolio. But that is a pass-through phase where I will have that amount in maybe an arbitrage fund, maybe a short-term fund, maybe a money market fund, or any of those instruments, and ultimately it will be used for that particular goal. So this is quite different from the strategic asset allocation. So this is the tactics which we are using to take care of the goal meeting requirement. So now the strategic asset allocation, the portfolio has to be constructed properly, which very much includes the long tenure fixed income portfolio. And when we talk about fixed income portfolio, it is not even that we have to look at only mutual funds. Almost all the viewers here would be using employee provident fund, public provident fund, these kind of instruments, which are also very, very good in terms of actually creating a very good portfolio of fixed income assets over a long period of time. And as far as PPF and employee provident fund are concerned, these are also tax-free. So it will compound for you for a very, very long time in those buckets. And if it does make sense for you, some of you might be doing voluntary provident fund also. It does make sense in some cases. But the only thing is, one should not overdo that because we need a proper allocation into debt and another allocation into equity. However good the debt is, it cannot possibly give you double-digit return. More often than not, it can never touch double-digit return. There have been instances in the past where momentarily or maybe for a few months it has touched double-digit. But if you really want a return which will beat inflation and give a certain return over and above that, then you necessarily have to look at certain other assets. So the typical growth assets are equity and property. And as far as equity is concerned, it is extremely volatile. But over a period of time, it has been seen worldwide that it gives a return much higher than the typical bank interest or typical inflation rate. So we need to have a healthy balance of equity and debt in one's portfolio. So now coming back to the question, we need to have a bedrock of long duration and medium duration portfolios in our kitty, so that will be the foundation on which we build the financial edifice. So the debt portion is going to be very, very critical for any portfolio because, like I said, that's the bedrock. And on top of that, whatever we want to do, whatever returns we want to earn, we are going to build an equity portfolio. Now, coming to whether it should be only long term, that also, we will have to see. There are various factors in that also. One of the factors is, of course, matching to the overall goals itself, because ultimately, whenever we are investing in something, ultimately it is not investment for investment's sake. Ultimately, it has to also take care of the goals which are also coming up. So some of the investments also will be matching some of the goals which are coming up, say maybe 5 years, 7 years 10 years down the line. And some of them will be simple strategic long-term investments. So it can be long-term. Long-term means it can be government gilt, it can be state development loan, it can be Bharat Bond kind of a fund, it can be a dynamic bond fund. Dynamic bond fund can have high quality papers underlying, but the durations can be different. It can be a banking and PSU debt fund kind of a portfolio. Again, the portfolio typically is high quality, but it will have bank and PSU debt papers. The other thing which we also normally use would be a high quality corporate bond portfolio. So these are all comparatively medium to long duration portfolios. Now, if you want to be on the short end, which is roughly 2 to 3 years, then of course you can pick up appropriate portfolios for that kind of a duration also. And then if you want to stay below that 1 year kind of a duration, depending on the duration that you want, you have a low duration fund, you have a money market fund, you have an ultra short term fund, you have a liquid fund. So depending on the portfolio duration that you want, you can actually pick and choose that as well. Apart from the various other things you can do outside of the mutual fund, which I had mentioned about. Now, one thing I forgot mentioning earlier in terms of the taxation is that if you were to buy a bond directly outside, the bond is going to give you a coupon, and that coupon is going to come to you whether you like it or not. So you are going to, that is treated as an income, and you will be paying an income tax on that as per your slab rates. In the case of a Bharat bond, because the fund is holding that bond, whatever coupon is going to come there, it is going to be reinvested, and you are going to be taxed only as long-term capital gain. That is assuming you hold for that 36 months. So this is a fundamental difference. If you hold a bond which is giving say 6.5%, on that coupon of 6.5%, you will be paying, suppose you happen to be in the 30% slab, you will be paying that 30%. In the case of a Bharat bond or any other bond fund where the underlying happens to be the bond, you will be paying much less tax. As I had explained before, it will be probably in single digits. So this is also a fundamental difference between directly buying a bond and investing in a Bharat bond kind of a product. Another fundamental difference is that we don't know whether there is liquidity in the case of these bonds in the secondary market. In the case of a Bharat bond or any other debt-oriented product where there is an underlying paper available, in that case, there is definite liquidity. So we don't know where we are heading. We don't know. COVID has actually taught us that. See, the point is we are living in very uncertain times. So we don't know. So we want liquidity, and debt mutual fund will give you that liquidity, in spite of giving you access to exactly those papers which you anyway want to invest in. Alex?
Absolutely. Yeah, absolutely, Suresh. In fact, we've covered most of the important aspects. I think my viewers will have a few more queries based on what you've said, and we can continue this conversation perhaps another date, Suresh, because like you said, when I said that I wanted to discuss this topic with you, discussing fixed income strategy might require a separate day altogether to discuss. So thank you so much for taking the time and for breaking this up. Viewers, I'm sure that you have a few questions. Do send them to us on any one of our social media platforms, and I'll be sure to ask Suresh the next time he joins us. Suresh, thank you once again for taking the time.